Hi everyone, my name is Mark Tokar, lead portfolio manager of the Accilent Select Portfolios. I'm here with Dan Pembleton, president of Accilent Capital Management. We're having a discussion about the markets. And in particular, Dan, I want to know what your opinion is of where you see commodities going in lieu of the Ukraine conflict, in lieu of where inflation is. Are there areas in the market that we can take advantage of to bolster portfolios or to perhaps hedge portfolios in lieu of the fact that we've had raging inflation, potential increases in interest rates? What are some of your thoughts there?
Thanks, Mark. Certainly the dominant influence, at least in the short term, is this Russian invasion of Ukraine, and really it's the sanctions that are being imposed on Russia and will be imposed on Russia, and how long they will last. So when you look at the energy complex right now, of course, very much spiking, which you would expect on any kind of major turmoil that involves a major oil producer and the number 2 exporter, which is Russia, on energy markets. So we've got that to contend with in the short term. What we have to think about is what will be the longer term result. Certainly, it seems we're heading towards a restriction in some respects of Russian oil getting to the market, but you wonder if it can find other markets, more of it going to China or other countries, and that will, over the medium and longer term, bring it back on the market and pull this initial spike down. I think that certainly will happen to an extent. They probably have a greater ability to do that than, say, even Iran did. So I think there will be some tempering in these expectations going forward. However, energy policies are being rethought around the world, most certainly in Europe, but also I think in North America and elsewhere. And we'll be looking at more preference for producers that are friendly producers and more secure producers. So I think in respects of Canada being one of those, I think we can expect to see good growth in our production over time. And certainly the U.S. itself, I think, will look internally and start taking advantage of more of its opportunities. So I would think we will put the high point in on oil very shortly, and then we'll see the markets function the way markets function, and that will moderate itself. Although we've probably bumped the long-term average price of oil up by $10 or $15 a barrel over what it otherwise might have been. The other areas that we'll see that are a little trickier to know right now is certainly Russia is a major producer of nickel and platinum and many other mined minerals, gold as well. I think the central bank will just buy their own gold. Their own gold production, so I don't see that changing too much. But there will be upward pressure on these other commodities, which have already been experiencing upward pressure. And I think I've believed for a couple of years now that we were entering a commodity super cycle, and I think these kinds of activities will restrict supply in the medium term and really the long term, and that will just extend the effects of the super cycle. So I think that for portfolios that are long materials, they want to stay long, look longer term. Don't try to play play the price spikes too much. I think the wind is at your back. If you're thinking out 5 years or longer, there will be some volatility along the way, but fundamentally, we are going higher in commodity prices, and commodities right across the piece as well. Certainly, energy's a big input cost to the production of all other commodities, and if the input costs are rising, generally that will also cause the price of the commodities to increase as well. So we've got a bit of a self-reinforcing cycle going on here, and portfolios would do well to reflect that. Again, we are portfolio managers, so I don't think we'd push all of our chips into one corner, but you certainly want to respect the major trends that are going on out there.
It's interesting you had mentioned the sanctions earlier on in your answer. What I'd like to get from you is maybe your thoughts on the inefficiencies that may arise from these sanctions placed on Russian banks through their use of SWIFT, and the potential there for, let's say, a banking crisis that may spread or some contagion. You and I both know that banks around the world are counterparties to derivative contracts. And what do you think the potential here is for a financial crisis that stems from one of those types of sanctions?
That possibility, really is, it's always there when you've got a lot of, like you say, you've got a lot of interconnectedness, particularly on a derivatives basis, which is off balance sheet and harder to see the systemic risks that exist in that kind of a situation. So those kinds of risks are in the system. When you get this kind of volatility, that's entirely possible, because you've got potentially large hedges that producers in Russia may have on the books, and or streaming contracts or other forms of supporting their financing that has occurred. And if now their ability, A, to move money around is impaired, and B, their ultimate commodity production is also impaired, there, certainly some of these derivative contracts could go bad, and that would, that could then, depending on the size, that could also have implications for banks in ways that we haven't really previously thought. I don't know. I'm not gonna mention any bank names here because I have no idea who's got what positions. But certainly when you've got these kinds of massive changes going on, that's generally not good for a financial system. Massive volatility is not good. Neither are big changes in the players. When you look back to Lehman Brothers in 2008 going bankrupt, that that really locked up the payment system. This isn't necessarily a Lehman Brothers moment, but we don't really know what's under the hood. So something that we have to watch for. There are usually signs that something's a problem. You start watching short-term Treasury bills. If those start getting bought up, and meaning their implied interest rates start going down significantly, that means somebody is only putting their money into very, very safe and liquid instruments. If the spreads, the interbank lending spreads start to blow out, that means that banks are now unwilling to lend, or less willing to lend to each other and support each other. That means that they're concerned about somebody somewhere having a problem. So these are things we can look for to see if there might be a shoe to drop. So far, so good. But it's only been a week, so we'll have to see how this plays out.
And that tends to be the problems with sanctions of this sort, especially with an economy that's so commodity based, is that the economy, it operates like anything else. If money can move quickly and capital can move quickly to areas of the world where returns can be generated and free trade is encouraged, then the economy works well. When we have these types of sanctions, it sometimes has unforeseen effects that might linger and not arise for months on end. And to your point, a lot of what these derivative contracts are off book. They're not easily discernible. It's not like someone can really go into a book and find these out, readily. So that's a concern. That certainly is a concern for the market, and something that we would be looking at as well.